Hello and welcome to the open house here on Money Mile. Like always, Surya Bhatia joins me to answer your questions. This is the show where we take your individual questions and give you an answer on what you can do with your money. Lots of questions have been coming in over the past few weeks, and we take some of them on this show. Padma Kumar Patil has this question. Please suggest a scheme between index funds and large cap funds which has a good return over a period of 4 to 5 years. And what are the tax implications of liquid funds and FMP, that's the fixed maturity plan funds?
Mr. Patil, first of all, you have asked about the query that how do you differentiate between a large cap and an index fund. I think with the recent SEBI recategorization of schemes, the scope of large cap funds actually have shrinked, but the real concern will come out, or the performance will come out over a period of time, because that's very recent change, and I think that's the reason why you've been asking about a shift between the index and a large cap. Logically speaking, in a country like ours, which is more of an emerging market, a developing country, generally we say that large cap funds are actually better options than index funds, because within the large cap space they can maneuver the holding of the large cap index which they have, and the percentage can change, which can lead to a better alpha for you of the returns being generated vis-a-vis an index fund. But as time will tell, because let's see how this really kind of fares about in times to come. But within the performances, if we talk about the last 5 years of performance of an index and large cap, you typically find a 15% return happening on an average between both the categories of index and large. So it's very hard to choose. And mind you, these are net of expenses. So it's not about that the large cap funds, which are a little more expensive than any ETFs or an index fund, but they are able to do an outperformance. But it's a matter of time when you will come to know whether we should pick up the index or a large cap fund. But as far as good funds are concerned within the large cap space, you can look at Axis Blue Chip, you can look at an ICICI a Blue Chip. These are pure large cap funds and have done well to their performance to consider being part of your portfolio. Your other query of taxation coming on the liquid and FMPs. FMPs typically come with a lock-in of 3 years. They also come for a shorter duration, but generally for a retail investor, they look at an FMP which are a 3 year of lock-in. And if these FMPs are 3 years and plus lock-in, they carry the tax advantage, because currently the tax advantage comes with a lock-in of 3 years. If you hold your debt investments for greater than 3 year period from the date of investments, the taxation becomes long-term capital gain. Hence, you get the benefit of indexation as well as a lower tax rate, which in today's time is 20%. So 20% with indexation is your rate. In case of a liquid fund, it depends on the period of investment period of your horizon which you're keeping the investment for. Typically, a liquid fund is not meant to be kept for a longer duration. Otherwise, you will not or should not be putting your money into a liquid fund. Hence, assuming it's meant for or kept for short term, less than 3 years, same principle applies over here also. Then it's taxable at your marginal rate of tax. So if you're taxable at 30% tax slab, and then liquid fund will also be taxed at the same slab.
And do you get the indexation benefit even for a liquid fund?
No, you don't get. The benefit of indexation comes only with the purview of holding the investment for more than 3 years. Only long term is applicable to take the benefit of indexation and not short term investments.
Okay. Here is a question coming in from Bablu Kumar, and his question is, what is an SIP and what are the benefits of it? How long does one have to invest in it? How safe is this investment?
SIP stands for Systematic Investment Plan. It simply also means, as you can come out from this meaning also, any investment which you do systematically, consistently, diligently is actually something inclined to a systematic investment plan. It can be done in mutual funds. For example, like even a bank RD is actually an SIP in a way, because you're doing every month a fixed contribution on a fixed day for a fixed interval on a fixed period of time. Exactly in a mutual fund, same thing applies. You do a fixed amount of money on a fixed day and you define the tenure of the investment you want to do. How long you should do an SIP? It really depends on you. Generally, the advice is the longer you do your SIP, better it is for your taxation advantage as well as for your rupee cost averaging. Your money makes better money for you if you are able to hold your investment for longer period of time. So it could be 5 years, 7 years, 10 years. I'm saying look at even 15 to 20 years, depends on how old you are, what your financial goals are, what your targets are. But the longer you hold, rupee cost averaging works in your favor, compounding works in your favor, and that's where the real money lies of the longevity of the investment you hold for. So the longer you hold, better from taxation, advantages from averaging your return over a period of time, and the probability of you making more money is actually very high.
Here's a question coming in from Prasad, and his question is, I would like to understand what is the difference between an equity-focused mutual fund and a multi-cap fund.
See, that's a good point which you have raised, Mr. Prasad. Typically, when this recent change happened on the categorization of the schemes, you have a multi-cap category, you have a focused category. Now, both these categories need to invest more than 65% in equity assets. A multi-cap can invest across sectors, across themes, and can be large cap as well as mid cap as well as small cap. Similarly for focused also, same thing is applicable. The only difference is that, as the name also says, you need to remain focused, and hence the number of stocks which you invest in the scheme should not exceed more than 30 stocks. That's broadly the difference between these two categories. So this is a little more niche category, and therefore the exposure to risk could be a little high vis-a-vis a multi-cap category, but because you still hold 30 stocks, I think that's very fairly well diversified category.
Okay, here's a question coming in from Avijit. He is 31 years old. He earns 40,000 rupees a month. He has 3 questions. I'll take them quickly, Surya. Yeah. He says his question number 1 is, I have recently changed my multi-cap fund from Motilal Oswal Multi-Cap 35 to Axis Focus 25 because I felt that Motilal Oswal scheme is not working well. Is this the right decision? Question number 2 is, he is invested in Kotak Select Focus. He believes it's not doing well. It has become a multi-cap fund. Is it better to stay invested in that scheme or to change the fund? And the third is, he has invested in L&T Emerging Business, and according to him, he feels it's not working well. He has invested 2,500 per month for his retirement corpus. He believes Canara Robeco Emerging Equities is working well. He wants to know whether he should continue in that or switch to Canara. His portfolio and his goal is the following. The portfolio he sent, these 4 schemes that he has. He says, I have just changed the multi-cap fund. I have a goal to buy a car of 4 lakh rupees without inflation, but I am unable to link with my investment. Please help me find a solution.
Dear Mr. Avijit, while you have mentioned these things, one of them you already executed from the multi-cap space, but let's take it one by one. Your first query on the Motilal Oswal, which you plan to shift or you have changed because that's what you have mentioned, to the Axis Focused 25 fund. Now, as we just mentioned about the difference between the multi-cap and the focus, exactly similar difference is applicable over here also. And if you look at the markets, before I come to the answer for this one in particular, if you look at the markets over the next last 7 to 8 months, markets actually have been a little polarized from the performance of overall scenario. You have kind of seen only handful of stocks which have actually led to the rally of the markets, and those stocks were actually having a very large weightage in the BSE and the Sensex as well as the Nifty. So that actually led to the belief that markets are doing exceedingly well, which actually was not the case, and only a handful of stocks actually have gone up. And depending on which fund was holding how much of those stocks in particular led to the upside trigger happening in those funds. So yes, you can call it a good call by those schemes and those fund houses. That should not be the only reason to decide the performance and to change the schemes. It is always good to look at a long-term performance of any scheme rather than looking at only in a myopic view of the last 6 months or 9 months or even a year's of performance. That's exactly what you have done over here. Motilal Oswal Multi-Cap 35 has been a great performer, done exceedingly well. Yes, last 1 year the performance is dipping, not doing well. Vis-a-vis the Axis Focus 25, again a very good performer in the last 1 year. Yes, this fund has done well over a period of time, but if you just go back just scratch the surface more, Focus 25 was not doing very well 2 years back. So therefore, you cannot just kind of pick up a fund saying based on purely last 1 year's performance. Nothing to take away from Focus 25, great fund, recommended, you can do this change, but whenever you look at a performance, please look at a 3-year to a 5-year performance instead of looking at a 1-year performance. Similarly, lies the answer to your query number 2, which is about the Kotak Select Focus. The Kotak Select Focus was earlier a large cap biased fund. It was not a pure large cap fund. It was actually categorized as a multi-cap fund, but the fund changed its gears and became a large cap bias fund. Now it's a pure multi-cap fund, but if you look at the portfolio composition, it still holds more of large cap vis-a-vis the mid cap space in the overall holding which it carries. Again, it has done little bit better vis-a-vis the other performers in the same space, but yes, it's not the top performer, it's not the quartile 1 performer in the last 1 year, but again has a very good solid track record, and the fund has done exceedingly well over a long period of time. So same principle applies. You have to look at the recommended schemes, the scheme which you buy for a longer period of time. So don't look at the last 6 months, 9 months, 1 year performance to change your schemes, because you will also have a tax impact on your portfolio besides exit loads. The third which you mentioned, the L&T emerging business vis-a-vis the Canada Robeco emerging equity, both are great funds, good performers. But again, you're looking at the last 6 months, 9 months performance. So my request to you is please look at little more longer investment performances to judge a scheme and even change the scheme. And when you mentioned the last point of yours about your buying a car and pegging it against a particular goal, what you can do is to make it more easy for you, buy one scheme for that particular goal of yours. So if you plan to buy a car with the money which you plan to save, you can look at maybe buying an equity fund, because that's we call that need of yours maybe as a luxury goal. And the way we define it, if it's a luxury goal for you, then you can take an extra risk in investment, so that you can, in case if it does not perform, you can always defer your need by another 6 months, 1 year. It's not too pressing a need that you can't change it. It's not like, for example, your child's education, which I can't even think of dream to change the scheme. Car, maybe 6 months early or 6 months late, I can manage it well. So look at equity, buy one scheme and hold on for long term.
Okay. Here's a question coming from Parth Sunara. His question is, I want to start an SIP in HDFC's Mid-Cap Opportunities Fund, but its AUM is one of the largest in the category. If I'm looking to stay invested for 30 odd years, is it better to avoid this? If so, what's the cutoff for recognizing a fund as too large for investment?
Parth, the point you raise is a valid point, but when you look at the AUM of a scheme and when you look at the performance, definitely what matters to you more is the performance and not the size of the scheme. Yes, beyond a point the scheme becomes too large, you can understand the logistics is that the fund manager, the team has difficulty in managing the scheme, and they may not be able to generate that extra return, that alpha, vis-a-vis the other schemes in the portfolio. But that's not the case with this fund in particular. This fund has done exceedingly well over a long period of time consistently, and that's what it matters. If the scheme has done well, you can actually consider picking the scheme. Yes, there are schemes likewise which have done exceedingly well, but I should not do the investment in this scheme just because the AUM has become too large, because it is not showing in the performance of the scheme. So far the performance is going on. I see no reason why I should not be investing the money in. Yes, you want to invest for a 30-year period, but what will you do if you buy in the scheme and that scheme does very well and becomes a big AUM? Will you change the scheme again? So you will not. Same principle applies over here also. The key for you is performance, and that's what really matters.
Here's a question from Saurav Biswas. Which one is better, SBI Magnum Multicap or SBI Focused Equity as a multi-cap perspective?
It's very hard to choose from these two schemes. If you look at the multi-cap and the focused equity, both are similar categories. Focused equity typically carries not more than 30 stocks. Multi-cap can be much more diversified and have larger number of stocks in the portfolio. Yes, focused equity has done a little bit better, you can call it, over the last maybe 6 months, 1 year period, but I think that's all about it. You have to see, focused equity will be a little bit more riskier, if I can say this, because it is a little more focused and will buy lesser number of stocks. But I think it's not too much to choose from, and you can just take a call what you want to pick. But don't pick both, because they both actually are mirroring each other. So it's good to pick up one of the two schemes.
Here's a question from Shantanu Sasmal. He asks that he's currently 30 years old and investing in an SIP of 40,000 per month. He wants to continue doing this for 5 years, after which he says he'll require a systematic withdrawal plan of 30,000 per month for his family. Please suggest the ideal fund for me.
See, that's what you have raised, Shantanu, is that you want to save this 40,000 rupees for the next 5 years on a monthly basis. It simply means you're going to save around 4.8 lakhs per annum. So if you look at 5 year, roughly you're going to save around 24 odd lakhs in that period. And then you immediately want to start withdrawing 30,000 rupees a month. What you have not mentioned is for how long do you want that monthly income to continue? So therefore, because this money will dip, this money has not become that large that you start withdrawing 70 to 80% of the principal contribution starting after the 5th year, because the key over here is, do you want the money to grow or do you want to use this money as a corpus which will start giving you an income from there? That's a call which you have to take. But because you have a 5-year period, you can look at it as a balance fund to invest the money, because markets are volatile and will remain so for some time. You can even distribute this amount into 3 parts. You can actually do a balance fund, a large cap fund and a multi-cap fund for the next 4 years. And from the 5th year onwards, you can start converting that corpus into maybe a debt fund, just make it more easy and get it little de-risk the portfolio, so that some part of the portfolio you can start withdrawing the money on the 30,000 rupees basis, on the assumption that the portfolio for the next 5 years will start yielding you some better returns, so that you are able to withdraw this money for a longer period of time, the SWP which you want.
Here's a question from Arindam Biswas. He says he has the following SIPs for the past 2.5 years. He's invested in the Kotak Standard Multicap, Motilal Oswal Multicap 35, Mirae Asset Emerging Blue Chip and DSP BlackRock Small Cap. He says that he has an investment horizon of 22 years and is a high risk taker. Wants to know how his portfolio is, and he says the current value is about 15 lakh rupees. He has very clear goals, and this is important. This is how you set your goals, like the way Arindam has done. He says 50 lakh is for the education of his child after 12 years from now. 80 lakh rupees after 20 years is for his daughter's marriage. And an accumulation of 3 crore rupees after 22 years is as this retirement corpus. He also wants to invest an additional 5,000 rupees, Surya, for accumulation of 10 lakh rupees for a Europe tour after 8 years. Should I go in for a thematic or sectoral or value fund to achieve it?
Arindam, you have good funds in your portfolio. You have a diversification of the multi-cap space, the large and mid-cap space, as well as the small cap space. If you want, you can, and you mentioned that you are a very high risk taker. So if you want, you can actually add one more mid-cap to the portfolio and reduce your multi-cap strategy. And that will even make the portfolio even on the higher degree of risk. Because you have a very long horizon, there is no harm if you consider doing that, provided you can stomach that volatility which comes along with the same. As far as achieving the goals is concerned, you will be able to achieve it. However, you need to increase your savings every year as your income increases. What you have also not mentioned is that whether the goals which you have provided for, are they inflation adjusted or not. If they are not, then you need to just pull up your savings a little more, because the retirement corpus which you have mentioned is on the steep side. Hence, you may need to push your savings on a higher end to be able to achieve the goals of yours. Fund houses wise, schemes wise, they are perfectly fine. And as far as your holiday saving is concerned, it's good that you can start creating your SIP book in this scheme for this particular goal in a mid-cap space, vis-a-vis doing into a thematic, sectoral or a value category, because then the fund manager can take a pick whether he wants to pick up a theme, a sector or a value stock, because he has a kind of all the process in place to decide which stock to buy, vis-a-vis you picking a particular theme and it may not perform.
Sanjay Kumar has this question for us. He says he's 33 years old and his monthly income, which is combined with his wife, is 2 lakh rupees. He has a home loan of 50 lakh rupees. He's been investing for the last 9 years in mutual funds. He has 4 mutual fund schemes. He says he started at 23 with just 500 rupees, and what a great example that is for everyone. You don't need too much money to start. He started at 23 with just 500 rupees. There are many of you 23-year-olds out there who can certainly save 500 rupees a month. So start now. That's very inspirational, Sanjay, that you started so long back. He's also continued to increase his SIPs over a period of time as per his advisor and his own research. He has some clear goals. He says he wants 1 crore rupees in the next 15 years for his child's education. His child is now 4 years old. And 2 crores in the next 25 years for retirement at the age of 60. That is a figure you really need to increase, because 2 crore at 60, though you say you've adjusted it for inflation, is still a little less, because you're going to have another 20-25 years to live after that. So you may want to increase that a bit. The schemes that he has, there are 5 schemes that he has: Reliance Value Fund, DSP BlackRock Top 100, Birla Sun Life Frontline Equity, SBI Blue Chip Fund Growth, and Parag Parikh long-term equity fund. He's also doing a 10,000 rupee per month recurring deposit, and he has an FD of 3 lakh rupees. 2 lakh he is kept aside as an emergency fund. 1 crore rupees term insurance cover, 5 lakh family health insurance plus standalone 5 lakh critical illness plus 20 lakh cancer/heart policy. And he has a total of 10 lakh rupees of cover from LIC, from Jeevan Anand and Jeevan Tarang, which he took in 2009. Wants to know if he's on the right track. He's certainly, Surya, done a lot of things right. And he seems like very conscious about the fact that he wants to build wealth and protect himself as well.
For long term, for sure. I think he's done commendable, as you just rightly mentioned, Vivek, that starting with 500 rupees when he was 23, which is 10 years back, when the awareness was also not so much. That's really commendable. But coming to your needs, Sanjay, which you have mentioned, you're currently saving around 48,000 rupees per month, which I think which is a good amount of money which you're doing. The schemes which you carry in the portfolio are too large cap biased. You have 3 schemes which are typically large cap schemes. So you need to kind of move out from large cap. It's good to have one large cap fund. And within the large cap space, you actually don't need too many of schemes because there is not too much which a fund house can do beyond a point in the large cap category. So it's good to go out from there and do a multi-cap, do a mid-cap. So just diversify your portfolio over here. And as far as the achieving of your goals are concerned, you have mentioned that inflation are adjusted. If that's the case, you will be able to achieve this. However, it's always good to increase your savings every year based on what your incremental incomes are. And as also Vivek just mentioned, that the retirement goal which you have provided for looks a little bit under provided for. So it's good that you will save regularly every year. If you can enhance your savings, I think you will be able to cover that reasonably well. Insurances are well protected, but do review your term insurances as well as medical insurances every couple 2 to 3 years, because especially your goal changes, your need changes, and in India the medical inflation is actually the highest in the world. Typically it's around 25% inflation on the health side. So you have to just keep an eye on that every few years take a review. You already have bumped up by having a cancer policy and you have a critical illness, which is great. But just to review about the same, you have taken an RD within the 48,000 of your monthly saving. I don't see a reason why you want to have that, because you have already protected your contingency emergency by having a FD. So I really don't see a reason why you need to have a recurring deposit happening for a reasonable big sum of money. That's 20% of your monthly saving. So maybe you can do that into a balance fund if you want to keep your portfolio a little more in a safe zone. But otherwise, increase your risk level, because the goals which you have actually are very long term, and I think then you should be able to achieve all the needs which you carry.
Thank you very much, Surya, for joining us as always. Well, we'll be back on the open house with many more questions. Keep watching the Money Mile.